Hello friends. Remember the stocks that skyrocketed during the pandemic? Are they still worth holding on to? Well, today we'll explore how some companies soared during the lockdowns and whether it's time to let go of these investments. By the end of this video, you'll have a better understanding of whether to hold onto these stocks or move on to new opportunities. So let's start by looking back at the boom of 2020. The pandemic caused a massive spike in the demand for specific stocks. Three standard examples are Peloton, Tesla, and Zoom. Zoom, with its lockdowns in place, became the go-to platform for virtual interactions. The number of users skyrocketed, leading to a 367% increase in its share price. The shift to remote work and virtual meetings was a game changer, making Zoom a household name. Its user-friendly interface and reliable performance attracted millions, from corporate meetings to virtual family gatherings. Moving next to Peloton, people stuck at home turned to Peloton for their exercise needs. The company's unique approach of combining stationary bikes with virtual training sessions led to a significant boost in revenue. Peloton offered a sense of community and motivation, which was crucial during the isolation phase. The ability to join live classes and compete with friends added a social element to fitness that was previously missing. And finally, we have Tesla. Tesla saw an impressive 850% rise in its stock price. The company thrived despite pandemic restrictions, recording a strong profit and increased deliveries. Elon Musk's acceptance of Bitcoin also played a key role in driving up the stock price. Tesla's innovation in electric vehicles and energy solutions captured the imagination of investors. Its consistent delivery growth and expanding market presence set it apart from traditional automakers struggling with pandemic-related disruptions. As we moved into 2021, the excitement around these stocks started to fade. When we talk about Zoom, the initial surge in app downloads during Q2 of 2020 gave way to a more stable but lower level of demand. Increased competition for Microsoft Teams, Google Meets, and others also put pressure on Zoom. The return to in-person meetings and hybrid work models reduced the need for exclusive reliance on Zoom, leading to a correction in its valuation. In terms of Peloton, consumer preferences shifted back to outdoor and group fitness activities. Supply chain disruptions and safety issues further damaged Peloton's reputation and sales. The reopening of gyms and fitness studios provided alternatives that many users returned to, impacting Peloton's growth. And finally, Tesla. Although Tesla continued to grow, its valuation became a problem for investors. The high price-to-earnings ratio led to a correction as stock price adjusted to more reasonable levels. Many novice investors who bought it during the pandemic also contributed to the decline through panic selling. Tesla's stock correction was a reality check for those who invested based on hype rather than fundamentals. Given the significant drops in these stocks, the question is there still value left? When we talk about Zoom and Peloton, while these companies are unlikely to go bust, it's doubtful they will return to their pre-pandemic highs. Investing in them now seems risky as their growth potential appears limited. Zoom needs to innovate beyond video conferencing, and Peloton's efforts to diversify their product line will be crucial and critical for their future success. Talking about pharma companies, the first movers in vaccine development like Moderna and Pfizer saw initial gains but have since struggled. Future pandemics might not guarantee the same companies will lead the charge, making these stocks less attractive at this stage. However, their ongoing research and development efforts in other areas could provide long-term value. And finally, we talk about Tesla and other similar stocks. Some value remains in stocks like Tesla, which benefited from the pandemic but also have strong fundamentals. Tesla's current price-to-earnings ratio is more reasonable, making it a potential long-term investment. The company's advancement in self-driving technology and energy solutions continue to position it as a leader in the market. It's never easy to change long-term investment convictions, but the best investors recognize when an idea has run its course. In today's market, there are plenty of new opportunities to explore. Holding on to stocks solely because they perform well during a unique event like the pandemic can hinder your portfolio's growth. Emerging technologies, sustainable energy, and healthcare innovations are areas with significant growth potential. Diversifying your investments into these sectors can provide stability and potential gains in the upcoming years. So friends, we urge you to stay informed, be cautious with your predictions, and focus on making well-researched investment decisions. If you found today's video to be helpful, please like, share, and subscribe. Staying connected means you'll always get the latest insights to help you navigate the financial markets. Highlight the subscribe button, and remember, by staying informed and understanding the limitations of market predictions, you can make better investment decisions. The goal is not to avoid mistakes entirely, but to learn and adapt quickly. Well friends, that's all we have for you today. Stay safe, and I'll see you all in the next video. Bye for now.